Hello and welcome to the latest in Sustainable Investors Asset Owner Interview Series. Many large asset owners are increasing their exposure to private markets. Drivers are higher returns, positive impacts and government policy, notably in the UK. Barriers include transparency, costs and liquidity. There are also questions about sustainability and stewardship. One organisation that has deep experience in navigating the private markets is the UK's Pension Protection Fund, and I'm delighted to be joined by the Head of ESG and Sustainability, Claire Curtin.
Hi, Chris.
Let's start with your role at the PPF and a little bit about the role of private markets within its portfolio.
Sure. So I've been at the PPF for just over 7 years now. We now have a sort of established ESG team. We sit within the investment team, and we're very much integrated into the day-to-day activities of the fund. In terms of the PPF itself, our investment portfolio is about 32 billion in terms of assets, and we are invested across all asset classes. But as you mentioned, private markets is an area that we've been investing in for a number of years now and actually have a reasonably significant allocation.
Mm-hmm. Now, when it comes to sustainability and in particular climate, where are the risks and opportunities in private markets, and in particular the different kind of subsectors across the area?
Yeah, so we find that the risks and the opportunities can manifest in quite different ways, and that really does depend on the asset class, but also the sector and the region that they may sort of sit within. We generally find for assets like some of the real estate and infrastructure sector, those kind of real assets, it's easier to kind of understand what those risks and opportunities look like. They're physical assets. You can understand that physical risks are going to become an issue in certain areas, so that's something that we would really incorporate into our sort of due diligence or expect our managers to. But for something like a media company and within our private equity portfolio, we have to have good exposure to those what you would call lower impact sectors. It's a bit harder to understand how climate might necessarily manifest. So really we're kind of thinking more holistically around sort of other ESG issues as well. It might be more that actually data security is some more significant. But we do ask for climate reporting as a sort of baseline across all of our portfolios where possible, because from a understanding at the fund level where our sort of accountability sits within financed emissions, the more information we can get across every asset, the better.
Mm-hmm. Now, I mentioned that at the top there's a number of kind of characteristics that are traditionally associated with private markets investments. They tend to be kind of different liquidity horizons. There tends to be less transparency across certain asset classes as well, and there's a different relationship in terms of ownership, I guess. How do those factors play into your oversight of private markets and across? Clearly, again, that differs across asset subsectors.
Yeah, so we always apply a materiality lens. So as the example I gave before with sort of different some we would always, as a starting point, consider what are the real issues that we think could be financially relevant or some material in the future to a particular investment. So that would generally be defined by the sector, or if it's policy risk, so the region in which they're operating. But at the same time, we have kind of minimum expectations for any asset, and that's sort of irrespective of the asset class or the whereabouts in the capital structure we may be investing. So when we're looking at new managers or some new investments, we would still have a minimum requirement on ensuring that those financially material risks have been considered within an investment process, we would still, want to see reporting. What that reporting looks like that's where you see more of the differences depending on the asset class in particular. We find that, say, in private credit, that's still probably a more challenging area to get data from. In part, so if we have legacy assets that we've been invested in for a long time, when those deals were made and the covenants and everything were all sort of agreed, it was in a time before really ESG type data was kind of being expected, so we can't go back and change those agreements. And similarly, from an influence perspective, we understand that where we sit as a lender is generally kind of lower in terms of that influence and ability to really sort of demand greater data. So that area, I think, is still, it's growing, and of course there are many different ways in which we might actually still be investing within that private credit space, but it's sort of in contrast to what we're now starting to see more from private equity, where actually if we if one of our GPs has a board seat, then the influence is much greater there, and we would then expect a greater level of reporting and transparency from that manager.
Presumably with private credit, as the terms of lending are kind of renewed over time, presumably those provide opportunity for the kind of terms to be introduced and for greater flow of information.
Exactly, yes. So I think this is probably still more region specific,
really?
But we have a couple of strategies more on the European side that are sort of considering ESG ratchets as part of that strategy. So sits within that sort of sustainability linked kind of debt. They're not green bonds, but there is some incentive to the company if they address a certain KPI, improve performance, then actually their debt terms would be more favourable. So there are opportunities, but as I say, we tend to see it more in the European markets than we would maybe in North America at the moment.
Okay. Now, one thing you've done to try and ensure that you've got good oversight is to create this transition and sustainable asset framework. Rolling it out over subsectors of private markets. Help me understand the purpose of the framework and how you've rolled it out so far.
Sure. So we started thinking about it actually from our own discussions around transition planning and what would a transition pathway look like for us as an asset owner. And because of our large exposure to private markets and accepting the illiquid nature, there's a lot of investments that we are holding now. So it felt like actually that was the more pertinent area to start, because that's going to really determine realistically where we can and can't transition. So we sort of did it as a bit of an about face compared to kind of most of these sort of ESG initiatives that come out, and started with the private markets rather than the public markets. And we wanted to understand where our managers were first before we dived straight into the assets. So we sent a short pulse survey out to each of our GPs, just asking them, what they were thinking about at a firm level in terms of transition strategy, and then more specifically for our mandate, and what analysis they had done on transition risks and physical risks, and whether they had identified certain pockets of the portfolio that may be more unlikely to transition. So it's just a series of, I think it was 10 questions in total, sent it out to everybody, so, got the results back, and then alongside that we started developing this framework more at an asset level. And we started with the infrastructure asset class first because it feels more tangible there. That's where obviously a lot of the energy transition focus, renewable energy, the enabling components of that is clearer to identify.
Also probably quite long-term assets as
Exactly,
well.
yeah. So you're looking 10, 15 years in a lot of cases. So we piloted it with the infrastructure sector, and we used what sort of taxonomies we could find out there, which actually from a transition perspective this was say 18 months ago, still fairly light. There are a couple of other larger asset owners, particularly in Canada, that had done some work on this and very gratefully public about the approach they'd taken. We also looked at obviously the EU taxonomy to identify what we would consider to be green or ready, and then other work from IIGCC in particular to start thinking more about what we've identified as the orange can help transition or is in a decarbonisation journey, but
so
not there
orange
yet.
Is amber then, I
Exactly.
guess.
So we did that assessment ourselves, and then we asked our managers for their views, and then sort of had dialogue with them to try and coalesce around agreement in certain areas. There weren't sort of every sort of subsector where we would have full agreement. I think toll roads is a bit of a ambiguous one where I think we were probably wanting to be a little bit more conservative.
Right.
But then obviously we wanted to recognise that our managers, they really know these assets inside out, so getting a bit more information from them about how they're sort of measuring any decarbonisation efforts within. So quite often they would have board seats in those sort of assets, so just getting that extra kind of nuance to it really helped. And then this year we've tried to sort of roll that out across most of the other parts of the private markets. We've still part private credit. We're doing that this year, but sort of for the delivery last year we focused on real estate and private equity.
Just quickly going back to infrastructure, you mentioned toll roads in particular, but what did the exercise really tell you about the climate specific and the transition pathways of those different assets?
It's a number of factors. Like what we find quite often is that people are still focusing on scope 1 and 2. So we get an alignment assessment using the net zero investment framework as a guideline. They say yes, this asset is aligned because they're looking at scope 1 and 2, and the company may have strategies in place to reduce its own operational emissions, but they're not really considering that downstream scope 3 impact. And so, well, actually, by its nature at the moment, toll roads are still enabling use with what's still a largely IC-based kind of vehicles. So
I guess the same applies to airports.
Exactly, ports, yes. And whilst we think that they're not necessarily the hardest to abate, they're not like cement or anything, but they are harder to abate sectors. But we want to we can see the opportunities in, if you can, and actually with some of our port investments, we're really starting to see amazing technological advancements in how they're even thinking about the berthing aspects with ships that can really reduce the emissions. I think one of our investments is sort of looked at the temperature you need to actually have frozen goods at, and just by reducing that temperature a couple of degrees, you could save huge amounts from an energy consumption basis. So sort of getting really into the weeds on that and understanding it has been very helpful, but we still want to sort of think longer term about that scope 3 and what those activities, where they're going sort of in that sort of 10-year time horizon.
So a lot of this was to an extent an exercise in understanding how well those managers know their sectors and their assets.
Absolutely, yeah.
And so you mentioned that there was this the setting up of the framework was done in parallel with a survey. What did that survey tell you about your manager's approach to transitioning the assets that they're responsible for?
Yeah, it was very clear that the real assets managers are in a much more progressive part of the journey. So our real estate and infrastructure managers, I think well over 75% of them already had either a transition plan in a more formal sense or a strategy in place. They had carried out assessments across nearly all our assets from both transition and from physical risk, like 95% from physical risk as well, which is good because we would be asking questions if they hadn't. Whereas in our private equity and private credit portfolios, it's about 50%. So, there are, I'd say, probably a little bit aligned in terms of kind of, regional bias as well. But positive to see that actually, 50% have sort of started, more formally thinking about this, and hopefully, by increased questions from asset owners like ourselves, they can see that that's something that we're really starting to take an interest in. So that will hopefully sort of grow a bit quicker again. But a clear divergence in where they are today.
And what are the kinds of measures that you're taking to increase those percentages?
So we're trying to understand which managers we have the most influence with. Generally it means which ones we're going to be allocating to the next vintage to, and or which managers maybe we're more concerned about because of what's in the portfolio. So a bit of a sort of a double-pronged attack, and just if in each asset class, if we can encourage one or two more managers to kind of get a bit further in terms of, we're not asking for formal transition plans, but to at least have some level of governance around it, and sort of knowing that the discussions are happening at a senior level, and also from a more bottom-up mandate-specific perspective, reporting to us much more. Now we've asked for the percentage of the portfolio assessed for this and this. We want to see those figures, sort of annually. But yeah, so even just one or two managers per strategy can actually really sort of shift. Certainly for the larger allocated managers, can shift our overall exposure.
Now, traditionally, private markets have different expectations in terms of the data and the timeliness of that data, the quality, the depth, etc. How are you finding the overall availability of data on sustainability metrics? How is that evolving in the private market sector? I mean, I know there's kind of solutions, there are industry initiatives. To what extent are these really kind of helping you shed light on your portfolio?
Yeah, we've seen a rapid increase actually just in the last couple of years. We started as part of a sort of pilot initiative through our portfolio management subsystem. They decided to reach out to the GPs, with the support of a number of LPs asking for this. And that first year we did that was 2021, 2022, and I think it was like 9 managers from our sort of list were in scope, and that's rapidly increased to sort of 40. So 50 managers now, and we're getting responses from at least 2/3 of those managers. So the uptake has actually, it's been really pleasing to see. The quality of the data and potentially the completeness of it is still something that will need to evolve. But just that first response engagement has been very, very pleasing. We've definitely found that the initiatives have kind of coalesced a lot quicker from the private market side than maybe what we saw in the public markets 5 years ago, where you had lots of different, almost competing sort of attempts, and so we've been a very big supporter of the ESG Data Convergence Initiative, the EDCI approach, and in part we've seen the support from US GPs in particular very strong within that initiative, and because we do have quite a high number of US managers, it made sense to us to support something that they seemed comfortable getting on board with. Even some of our smaller private equity managers are committing to reporting through that initiative now, which is great to see, and feels like a couple of years earlier than I actually would have expected, given how long it took really for the public market stuff to roll out.
And are your expectations still different for public markets managers versus private markets managers?
I think so. We've kind of been a lot more, a lot less fussy about, the number of metrics, the depth of it. Actually, some of the sort of SFDR type indicators became quite quickly adopted. The PAI sort of indicators in particular. So, there's 15 or so metrics that actually most GPs are now getting used to being asked about. And it doesn't give us everything, but just to get 70% of the way there, and have something is a really good starting point. And then, as time moves on and, hopefully technologies improve and that sort of, data capture with AI tools, etc., it will help kind of build around the edges. But just having a smaller number but more adoption that's been the approach that we felt was better to take, rather than searching for perfection, which I think a lot of us probably were a bit in danger of doing a few years ago.
Okay, so also in terms of those kind of expectations of private managers, clearly stewardship is a huge part of oversight of sustainability metrics and performance. Not something that we normally associate with, or historically associate with, private markets. How are your expectations evolving there?
It's definitely still in an evolution, and it really does depend on that sort of control element, or kind of how it's viewed materiality wise. We see a lot more evidence around value creation now within private equity in particular, and understanding that improving certain approaches, putting policies in place, that sort of general kind of upskilling within a portfolio company really pays off when you're then looking at sort of exit values. So, it's not sort of your go and meet company management to talk about an issue type stewardship, but we still see it as, as being active owners. So for us, we would still consider that in our kind of stewardship expectations, and that's the kind of reporting that we would start asking from our managers. But there's probably still an element of kind of reputation aspect as well. So if a lot of companies smaller don't have necessarily the same systems management in place, and if an issue does arise, then we would be very quick to expect some kind of resolution from our GP, and sort of targeted improvements around a particular issue. So it's probably still a little bit of a reactive element in some cases.
I guess what those portfolio companies do have is the kind of ability to create value through their pursuit of sustainability objectives, or having sustainability in their business models. Presumably that's a bit of an evolving science in terms of identifying how sustainability creates that value.
Absolutely, and it's where we can really see real economy benefits, but sometimes it's talking about it in a different language, almost, less ESG and more aspects like the value creation. So I think the terminology, we're having to sort of learn a bit more from our side in terms of how we're asking for that information and then sort of, receiving that evidence back. But very much, that's where we see the opportunity in private markets. Is you're getting that effort and that outcome into the ground pretty quickly.
So, having put in place the framework and engaged with portfolio companies and managers, where does that leave the firm in terms of setting kind of resetting its targets and expectations for decarbonising the portfolio, but also incorporating sustainability into the investment process?
Yes, we're definitely not at the setting target stage on that. We're really sort of trying to get that more complete sort of categorisation sense, but it's also something that's now informing pre-due diligence as well. So identifying opportunities, areas or themes that we can see that value. If sort of on the opposite side, if there's assets that is similar to ones that we've kind of already categorised red, and then more questions around what that pathway looks like for that asset. It's not that we wouldn't invest in what we would consider red assets, it's that we would need to see some strategy or decarbonisation aspect being put into that management plan. So we need to know that our GP is thinking about how that would play out within that particular portfolio company.
Okay. And so finally then, based on the experiences of the last couple of years, what are the lessons that you would draw, that you would want to share with other asset owners?
I think now that we've largely done the private market side, we're turning our attention sort of back to the public markets, and actually, from an internal versus external kind of management perspective, we have more money that we're managing internally on the public market side, and I think a lesson, not to say a lesson learned, but a realization that we can't take this same approach asset by asset in a 3,000 stock sort of equity portfolio. So we need to be a little bit kind of smarter about how we assess en masse for those portfolios. But the data is certainly for the kind of green taxonomy aspect, the data is much more available. We can get it from our research provider, and you can sort of download it in an instant from your system. But the transition assessments are still, there is no common transition taxonomy yet, and even the early conversations we've had with some of our public markets managers, they're all thinking about it in a slightly different way. So transition, alignment, there's probably more commonality on alignment now. So the NZIF has definitely sort of helped with that, but transition is still quite unique in the way that each house is thinking about it. So we've realised that yes, we can kind of ask for this information from their perspective, but it's inconsistent in terms of aggregation. So we actually still need to think about it ourselves. So that's where we are today, is trying to work out how we can do something much more scalable, but sort of still keep it simple enough that it can be aggregated across a broader portfolio.
And is that reflected in your kind of clearer expectations to your managers about what you expect going forwards?
Yes, absolutely. So we've been asking for reporting from our public markets managers for 5-6 years now, but this is the new wave of information that we're now starting to request from them. And there's a bit of a kind of learning on, because a lot of this stuff is done in-house from their perspective, getting everything from them is not always as easy as a carbon footprint might be. So it's about understanding their philosophy and their methodology at this stage, and then I guess we can get hotspot information. So what are the 10 largest exposures, or the 10 companies that you think are least likely to transition, and what are your own engagement plans around addressing that. But yeah, it's still work in progress.
Okay. Well, Claire, thank you very much for sharing those with us.
Thank you.